Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, how the economy fares may depend on how we feel. So how's it going? And the tight jobs market of yesterday is giving way to a weaker one. Plus, we're looking ahead to next week's fall fiscal update from Ottawa. What does the business community want to see? That's all ahead. First, for the week that was in business, it's time for the briefs. Inflation in the U.S. slowed in October to 3.2% from 3.7% the month prior, with prices flat between September and October. It was a welcome sign that central bank action on inflation may be working, and it bolsters hope that rates have seen their highest level for now. Still, inflation in some areas is still running hot, including rental costs and many services. Households have a sour outlook on their own finances. In fact, things haven't looked this grim since the start of the pandemic, before government supports kicked in. That's according to the latest Bloomberg Nanos measure of confidence. Measures of confidence in personal finances, job security, and the overall economy are all down.
We're expecting that we'll see a soft 2024 on the economic front with a bit of a flat economy. So not positive news when it comes to economic confidence right now.
Nearly 7 million Canadians struggled with hunger last year, according to new data from StatsCan. High inflation was to blame for that rise in food insecurity. 18% of the Canadian population reported some form of it, including buying less food than required as food prices rose. The federal government has committed $1.2 billion to support construction of 7 rental projects that should create 2,644 new units in Toronto. It's part of the $25 billion rental construction financing initiative announced in 2020. Some of the projects are already under construction. In total, the program aims to help build 71,000 new housing units by 2028. U.S. investment bank Goldman Sachs is getting positive on commodities. Goldman says as the economy moves past rate hikes and a recession, the case for commodities like oil and industrial metals gets strong. It's part of a growing view by market participants that the U.S. economy at least has dodged a rate-led recession. If it's accurate, it would be good news for Canada's resource-rich economy. Donald Trump's alternative social media platform, Truth Social, is struggling financially and may not continue as a going concern. In a filing with U.S. market regulators, it was revealed that it lost $23 million U.S. in the first 6 months of this year. And those are your business briefs. With interest rates at or near their peak and wages rising for the past year, you'd think consumers might be feeling a little bit better, but reality may be a bit more complicated than that. Pedro Antunes is chief economist at the Conference Board of Canada. Pedro, thanks for being with us.
You're welcome. It's a pleasure.
So it feels as though we're at a bit of a pivot moment. We're starting to see certainly market participants get very excited that interest rates have peaked out and we may well be dodging a recession. Would you expect to see confidence improve among Canadians?
Well, it hasn't yet. I think people are still very concerned about the current situation. I think they're still very concerned about the impact that some affordability issues and showing up in inflation numbers are still having on a lot of households. I think we're still hearing lots about potentially, more risks to the downside than certainly to the upside. So I think all of these things are keeping certainly our survey of consumer confidence on the very low end. In fact, still very much at recession levels when you look at where confidence is at today.
And in a way, in the sense that reflects reality, Pedro, is that a positive thing, if I can put it that way? In other words, if, for instance, people rein in their spending this Christmas, that's bad for parts of the economy, but it might be a reasonable thing to do when you're worried about, your job and your mortgage and overall household costs.
Yeah, I think it's a really tricky balance. I mean, for households, obviously, they have to weigh all of these things. And I think when we hear about essentially monetary policy being successful in slowing consumer spending down, especially in Canada, but more importantly, perhaps in the U.S., then we're saying, I think what's reflected in the markets is that this is good news and there's a little optimism. We certainly saw the inflation numbers in the U.S. down this week, and then that's helped kind of certainly regain market optimism, if not consumer confidence yet. The other thing I think is really important is, this is hitting different households very, very differently. So if you're low income, younger household with a lot of debt, this is going to have a very different impact than if you're an older, higher income household with no debt or very little debt. And I think that's showing up in the consumption patterns as well.
Can we take some comfort in how strong that U.S. economy appears to be? It is not our economy, and we can sometimes get them mixed up. But we're very reliant on how the U.S. does, and it seems to be doing pretty well.
Yeah, well, I think the weight of higher mortgage costs on U.S. consumers is much, much lower. First, because they're less indebted. And second, and perhaps most important, is that in the U.S., 30-year mortgages are the typical. So there's no renewal of most mortgages like we're seeing here in Canada. So the pain of these higher rates we haven't seen here in Canada yet. So, and I think more importantly, though, is, the U.S. economy is such a big part of kind of driving world kind of the world economy. And if monetary policy is successful there, that'll have implications for lending rates throughout the world. Even if we are able to set our own interest rates here in Canada, when you look at mortgage costs, they're going to be reflective of what's happening in the U.S. So, yes, resilient economy in the U.S., and good news that despite that resilience, inflation is coming down.
I guess we've only got 30 seconds, but you referenced the kind of mortgage renewals. That could, of course, drag out over a couple of years. 2025, 2026 might be when we see a lot of renewals happening. Does that mean that this kind of period of malaise might be dragged out a little bit in Canada?
Well, certainly, and I think depending on the household and how much debt you have and where you are in your mortgage, this is going to have, I think, significant implications. And I think what we're seeing now too is that longer term, we're seeing rates probably well above what we saw pre-pandemic. So that hope that we'll see a return to those very, very low interest rates that we've had for decades, I think that's kind of evaporating, and we're coming to the reality that it's going to be harder to get a mortgage and to pay for debt in the future.
Pedro, so good to have you. Appreciate your time today.
You're welcome. It's always a pleasure.
Pedro Antunes is chief economist at the Conference Board of Canada. Coming up, we've heard about Canada's tight labor market for years. Suddenly, it's not feeling so strong. We'll check in on the picture for jobs next.